So overall, I think we're not at like bear market depths of, like depression, but we don't have characteristics of multi-year tops. And I look at other things. I look at like the age of coins moving on the network. I look at Bitcoin in relation to what's going on in macro. I look at the MNAV, so the market value to net asset value of publicly traded Bitcoin treasury companies. Nothing right now is indicating extremely high froth levels. I think we're more in like a mid-market type territory. Yeah, so one thing I covered in that presentation is that we've crossed over 100 trillion debt, which includes public and private debt. So that's kind of total debt in the American system. It's obviously higher than that when you look at globally. One of the things I pointed out too is that the number of years that they've ever gone down is extremely low. So in the entire kind of period that we've been alive, and even our parents probably have been alive, the total debt in the U.S. only fell one time, and that was 2008 during the global financial crisis, and it only fell by 1% before they started money printing. And if you look at the longer data set, going back all the way to the creation of the Federal Reserve over 110 years ago, there were four other years where total debt went down, and they were all in the Great Depression. So 1930 to 1934, and then that got too painful for them, so they printed. And so 5 years out of the over a century where they ever let that debt fall, because the way it's currently structured, central banking with fractional reserve banking built on top of it, and then debt securities built on top of that, it kind of has to keep increasing or it runs into issues because it's so incredibly levered. When it gets levered 20 to 1 or 50 to 1, as it normally is, 50 to 1 being at those kind of peak periods, they don't really have any ability to ever let that even unwind a tiny bit, because even a small unwind is like bigger than the monetary base, and so they're pretty quick to pull the money printing trigger. As for how bad it's going to get, so we're already past kind of the private sector deleveraging peak. So the two times in American history where that happened were, one, the Great Depression, so early 1930s, and two, the Great Recession, the global financial crisis of 2008, 2009, and the few years after that. And now we're more in the public debt cycle, which is that more debt is transferred to the federal level. Basically, I view it as more of a long grind than an event. So, for example, I'm not really calling for a crisis in the next handful of years. I mean, who knows what can happen with war or geopolitics? But aside, not putting that stuff aside, in terms of just the U.S. money system, I'm not really looking for crisis. It's more like positions that are currently disadvantaged are going to continue to be, and ones that are currently advantaged are going to continue to be. And so, basically, if you're on the right side of those deficits, it generally feels pretty good, and people wonder why are people complaining? What's the issue? And if you're not on the right side of those deficits, you're getting squeezed pretty hard because you're getting all the debasement associated with those deficits, but you're not on the receiving side. So you're getting diluted. There's kind of this value being transferred away from those people and toward others in a fairly opaque way. So how bad it's going to get depends on how either fortunate or unfortunate you are in the stack, and then also what you're doing, be aware of it, and then protect yourself from it.
And what do you think could happen or will happen if the US as a nation is going to lose their reserve status?
Well, I think that's more of a process than an event. If we kind of point to when did the UK lose their reserve currency status, there's a couple milestones that were important, but none of them were like the day. And so there was a period of time where the U.S. surpassed, the biggest economy in the world. Then Bretton Woods moment was obviously a huge moment, but the UK debt was still pretty widely held. Then there was the Suez crisis, where the UK lost political clout, and then it's really been a long grind of losing it ever since. There's still a reserve currency, they're still in the top five of like held currencies, but not very much. And they've never had this kind of massive crisis because of it, but they've had a deterioration in their global standing and kind of the aftershocks of that. So I think that the U.S., by some metrics, we already hit peak U.S. dominance, which is you can look at, say, U.S. dollar share of global reserve assets. You can look at U.S. Share of global GDP. There's a couple of different metrics you can look at. Whether or not the U.S. is the biggest trading partner with most countries in the world or not, we've lost that to China. And so I do think we are over our hump. We're over our peak. But I think there's this kind of like long tail that goes forward. In addition, people, when they think that, often assume that another currency has to replace the former currency. But historically, that really only happened like one time. For most of history, kind of modern history as we know it, Gold was really the global reserve currency, and the other currencies were just these like overlays on top of that. They were instruments that were generally backed by gold or backed by silver in some cases, and it was whatever the kind of the country that was exploring the most, that was kind of this biggest growing economy, and therefore the most recognizable. And as they would kind of expand and then contract, and some other entity would take over, that would kind of displace them. But ultimately, it was gold for gold and silver for most of that history. We did have a handover where the UK went to the US as a global reserve currency, but people often assume that the US has to hand it over to someone else, like China or whatever the case may be. I make the argument that I mean, this period was an anomaly. This isn't something that's going to keep repeating. This kind of U.S. dominance period was an anomaly. So after World War II, the U.S. was over 40% of GDP. Most of the world was destroyed. The U.S. had by far the most gold, biggest manufacturing base, really strong demographics, by far the biggest military. The homeland was mostly unscathed by the entire war, and so it was just like a hyperpower position. And so everything was kind of built on top of that. And over time, we've fallen from over 40% of GDP to 15 to 25%, depending on whether you're looking at nominal or purchasing power parity GDP. We're no longer the biggest trading partner. And so as you kind of go by different metrics, we've been shrinking. But there's really no other currency block that's going to recreate that 40% of GDP hyper dominant situation. And that's, I mean, if anything, that's a healthy thing. That was an anomalous period where like most of the rest of the world was destroyed. And if you look at kind of long run history, like China and India used to be pretty big percentages of global GDP, stretching back a very long time. But in the era of kind of Western exploration and colonialism and stuff, they I mean they were on the wrong side of the technology war that happened, so they radically shrank as a percentage of global GDP despite their large populations. And if anything, the recent return of India and China to rather large chunks of global GDP is back to the normal state of affairs, given the size of their population and the long-standing history of their cultures. So I think we're entering a more multipolar world is kind of the punchline after that long ramble I just gave. We're entering a more multipolar world, which generally means two things. One, neutral reserve assets reassert themselves in the system. So the biggest one would be gold, but obviously Bitcoin's a newcomer with a lot of really attractive characteristics. And it also means to the extent that fiat currencies are held as reserve assets, there could be more diffused holding of them. So rather than one being, say, 70% and like the next four making up the other 30%, you might have the top one be 40% or 50%, and the other four make up, the rest of that, or the other nine top ones make up the rest of that. So you have a more diffused currency base. The earlier phase, and we're seeing early signs of this already, is sovereign wealth fund investment. And the reason that distinction matters is because a reserve asset, something held by, like, say, a central bank, is meant to be there when you need it. If you need to say one or two things, either you sell it to buy back your own currency to strengthen your currency in a currency crisis, or if, like currently, there's a lot of dollar-denominated debt in the world. So there are banks and there are corporations and governments around the world that have dollar-denominated debt. And in a dollar shortage, like let's say, for example, when pandemic lockdowns happened and all the global trade dried up and all the dollar flows contracted, but these debts were still owed, having dollars at the sovereign level in some way is useful because then they can loan them to their domestic entities that owe dollars and keep their debts solvent. So either to backstop the currency or to backstop their offshore debt liabilities. And so that's generally a large liquid asset like gold as a reserve asset, or more commonly, dollars and treasuries. Bitcoin being small and generally also being something that there's not a lot of liabilities denominated in, it's less going to be picked in the near term by central banks because they can't say, look, in 18 months from now, if we have a currency crisis, if Bitcoin's cut in half relative to what it is now, that impairs our ability to defend our own currency. The volatility is kind of too much for that kind of reliable need that is required. And instead, where we find it is creditor nations have big sovereign wealth funds. And these funds are not meant to be used in emergencies. They're not meant to be time-specific moments to backstop a currency. If anything, their currencies are very strong because they're major creditor nations, and they've intentionally weakened their currency in many cases. And instead, they're saying we want to build sovereign wealth for the next 10 plus years, and kind of backstop our citizens' retirement or our sovereign ability to maintain dominance, whatever the case may be. And that's where we're seeing Bitcoin show up. So it's not really earmarked for any kind of intermediate term purpose. And I think that makes sense for where Bitcoin is at this stage. So as a $2 trillion volatile 16-year-old asset, I think that makes sense. So I think we'll see it more and more in sovereign wealth funds. And then, one day when we add a zero to its market cap, hopefully, and it's way more widely held and less volatile, I think that's when you can see it show up in as a reserve asset as well, because at that point it has gold-like characteristics or treasury-like characteristics, where it's this large, liquid, highly understood asset that is there to be sold kind of rapidly when needed. There are a couple of things I monitor for signs of bubbles. There's no like one killer metric that can tell you if it's a bubble, and also you don't even know when a bubble is going to peak. I mean, a bubble could turn into a bubble twice as big before it rolls over, for example. That happened to a lot of people in the dot-com bubble. It was like they were looking at the market in like 1998 and think this is pretty frothy, and then it's like, well, you haven't seen how high it's going to get.
Yeah.
Um, but I look at my favorite metric is market cap to on-chain cost basis. Basis, okay, what is Bitcoin market cap? That's easy to measure, price times supply. And then you look at on-chain cost basis, which is basically pricing every coin at the time it last moved on-chain, which statistically mostly means the time it went to or from an exchange. Those are the biggest moments for that metric, and that creates kind of a psychologically important number. It's also basically it's kind of like volume adjusted market cap in a way, because and the analogy I use, if you have 20 houses on a street and none of them have sold in a few years, and one of them sells for double the price that it last sold at, you'll generally see that all the other homeowners mark up their real estate at to the level that that new one sold at. But that's the liquid price. That's like, 5% of those houses moved and the whole street's now twice as valuable. But it's not clearly the case that if 10 of those were to sell, they would all sell at that higher price. And Bitcoin's obviously a much more liquid asset than that, but there's still a part of truth to that, which is if you get a really quick price move to a new level, if it does start to unlock a lot of existing supply, that price is not necessarily maintainable at that new high level in that window. But if it kind of reaches a price level and then spends 6 months or 12 months or 18 months chopping along at that level for a period of time, and the cost basis goes up and a lot of volume and a lot of liquidity has occurred at that new level, then that's a more meaningful liquid kind of price level for the asset. And so during prior multi-year peaks, we can call them bubbles, I suppose, because you kind of had a few years of a bear market afterward, they hit very high levels by that metric. Currently, we've not hit anywhere near the levels that are historically associated with multi-year drawdowns. There are times we hit, I would call it moderately frothy. So, for example, in March 2024, which was the near-term aftermath of the launch of the US spot Bitcoin ETFs. So there's a little bit of a fervor there, a little bit of a rapid price jump. We briefly touched new highs at something like 73,000. And that metric got a little bit frothy, but it was nothing like one of those, multi-year periods. And then we did end up consolidating for like 7 months, which makes sense given the moderate froth we had. Then, shortly to your point, right after October, when we had an election in the US, a much more favorable environment to Bitcoin, that was kind of a catalyst. But that was after a 7 month consolidation. We were in a pretty good space valuation wise. We jumped up to, what was it, 107,000 or 108,000 thereabouts. And that reached similar levels of like moderate froth. Again, from November until April, May, we were in this consolidation phase, which makes sense, a multi-month consolidation for a little bit of froth. We eventually worked past that. We've touched new highs. We pulled back a little bit. So overall, I think we're not at like bear market depths of like depression, but we don't have characteristics of multi-year tops. And I look at other things. I look at like the age of coins moving on the network. I look at Bitcoin in relation to what's going on in macro. I look at the MNAV, so the market value to net asset value of publicly traded Bitcoin treasury companies. Nothing right now is indicating extremely high froth levels. I think we're more in like a mid-market type territory.
Welcome to the deep dive. This is where we try to take, all that source material flying around, articles, research, maybe notes you've sent us, and really just cut through the noise.
Yeah, find the crucial bits, the stuff that actually matters.
Exactly. Think of it like a shortcut, helping you get genuinely informed without drowning in information. We're aiming to dig into the data that counts. And just for context, this specific analysis we're doing today, we're calling it episode 30 of our series, The Market Chronicles.
Right.
So if you happen to be watching this on YouTube, seriously, go ahead and hit that subscribe button. We've got plenty more deep dives like this planned.
Definitely worth it.
Okay, so mission for today. We are digging into some really insightful analysis, particularly from Lyn Alden, looking at the big macro picture.
Yeah, the really big stuff.
We're zeroing in on, well, the U.S. debt situation, which is pretty eye-watering, and then the whole question around the dollar's reserve status, where that might be headed long term.
And how assets like Bitcoin fit into all of this, or maybe don't fit yet.
Right. So the plan is to unpack the main arguments, look at the key data points she uses, and just try to understand what's really going on beneath the surface.
Absolutely. And it's a very clear-eyed perspective in the source material looking at the structure of things. So where should we start? The debt.
Let's start there. That number is just staggering. The analysis points out that total U.S. debt, public and private combined, has blown past $100 trillion.
$100 trillion. It's almost hard to conceptualize, isn't it? It represents this massive claim on, well, future economic output.
You see a number like that and you think, hey, unsustainable. It's got to pull back sometime, right?
You'd think so. But the historical context in the source material is maybe even more telling than the number itself.
Wow, so?
Well, it looks back over a century, basically since the Fed was created. And in all that time, total U.S. debt has only actually fallen in 5 years.
5. Only 5 years out of more than 100.
Wow.
4 of those were 1930 to 34. You know, the absolute pit of the Great Depression, a catastrophic unwinding.
Okay, so extreme circumstances. What was the 5th?
2008, global financial crisis. And even then, the drop was tiny, like 1%, before the money printing kicked in again and debt just resumed climbing.
So the system seems incredibly resistant to debt reduction.
That's the key takeaway. It highlights something fundamental, maybe a bit counterintuitive, about how our modern financial system is actually built.
And the source explains why it's so resistant, right? It's tied to the structure.
Exactly. It boils down to leverage. The whole system of central banking, fractional reserve banking, it runs on immense leverage. Think 20 to 1, maybe even 50 to 1 at peak times in certain areas.
Okay.
So in a system like that, where most new money actually comes from loans creating deposits, it struggles badly if the total amount of debt even starts to shrink significantly.
Why does it struggle?
Because a big debt contraction puts huge pressure back on the monetary base, the actual central bank money. It can cause this sort of domino effect much bigger than the initial debt drop might suggest. So this structure, it almost forces debt to keep growing. Central banks, they're basically designed to step in and stop any serious debt deflation. They have to keep the debt expanding.
It's like the growth is baked in.
Yeah.
And the source mentions a shift in where that debt growth is happening now.
Yeah, we've seen phases like after 2008, you had households and companies paying down debt, deleveraging. That was private sector focus.
Right.
But now the analysis suggests we're mainly in a phase where the debt is shifting onto the public side. It's federal government debt that's really ballooning.
So the government balance sheet is soaking it up.
Pretty much. It's become the main place for the sort of necessary system-required debt expansion.
Okay, so huge debt, structurally needed, moving to the public books. You hear that, and you might immediately think, okay, crisis incoming, hyperinflation, collapse. What's the view in the analysis?
Well, this is where it gets a bit more nuanced, maybe different from the really loud alarm bells. If you set aside, massive external shocks like a huge war or some completely unforeseen geopolitical event.
Right, the black swans.
Exactly. Setting those aside, the analysis suggests this isn't pointing towards an immediate sharp crisis. It's described more as a long grind.
A long grind. Okay, that sounds unpleasant, but maybe not explosive. What does that actually mean for people, for the economy?
The main thing highlighted is this ongoing kind of subtle transfer of value within the system.
Transfer of value. How does that work?
Well, because the system needs debt growth, and it's increasingly public debt, right? Deficits. That deficit spending or the stimulus it funds creates benefits somewhere.
Like asset prices going up or specific programs getting funded.
Precisely. So the argument is if you're positioned on the right side of those deficits, maybe you receive the spending directly or your assets inflate because of liquidity, you tend to do okay during this grind. You might even wonder what all the fuss is about.
But what if you're not on the right side?
And then you feel the other side of it. You experience the debasement, the value dilution that comes with all that debt and deficit spending, but you don't get the direct benefits.
So your purchasing power erodes.
Yeah, it's like value is slowly, maybe opaquely being transferred away from you. It's not like a sudden shock, more like a slow leak in your financial boat. How bad this long grind feels for you personally really depends on where you stand in that system and, crucially, what steps you might take to protect yourself.
That's a really important distinction. The value transfer isn't always obvious. Okay, let's shift to the global view, the dollar. Is its reserve status facing a similar kind of slow grind, or that more of a sudden risk?
Again, the perspective is very much process, not event. Think gradual shift. The source uses the British pound as a parallel.
How so?
Well, the pound losing its top spot wasn't an overnight thing. It took decades. You had milestones, right? The U.S. economy overtook the U.K.'s. Then Bretton Woods basically locked in the dollar. Then the Suez Crisis showed the U.K.'s power was waning.
Right, I remember reading about that.
And after that, it was this long, slow slide in the pound share of global reserves. It's still a reserve currency, just not the dominant one. And importantly, losing that top spot didn't cause some immediate UK collapse, but it definitely coincided with a long-term decline in relative global standing.
Okay, so applying that history lesson to the US dollar today, where does the analysis say we are in that process?
The argument is that the U.S. has likely already passed its peak dominance, judging by several key metrics.
Like what?
Things like the dollar's share of global reserves, it's down from its highs,
Right.
or the U.S. share of global GDP massive right after World War II, like over 40%. Now it's more like 15-25%, depending how you measure.
That's a big drop.
Huge. And maybe most significantly, the U.S. isn't the biggest trading partner for most countries anymore. China often is. So these signs suggest we're kind of over the peak and maybe in that long tail phase of gradual relative decline.
And that post-World War II dominance, the source says that was unusual.
Highly unusual. A historical anomaly, really. The U.S. had most of the world's gold, the strongest manufacturing, the top military, and its homeland was untouched by the war while others were devastated.
A unique set of circumstances.
Exactly. And the analysis argues that kind of hyper-dominance by one single nation is very rare and unlikely to be repeated anytime soon by anyone.
Which leads where, if not one dominant power?
Precisely. It leads to the idea that we're heading into a more multipolar world. Not necessarily China replacing the U.S. one for one, but a system with multiple major economic players, multiple currency blocks. Power gets more spread out.
Okay, a multipolar world. What does that actually mean for currencies and assets? What are the main consequences highlighted?
Two main things jump out from the analysis. First, neutral reserve assets tend to become more important again.
Neutral reserves, like gold.
Historically, yes, gold, because it sits outside any one country's control. The source suggests Bitcoin, with its, quote, attractive characteristics, decentralized fixed supply, etc., could potentially play a similar role over the long run, a modern neutral asset.
Interesting. And the second consequence?
Fiat currency holdings get more diffused. So instead of central banks holding, say, 70% of their reserves in dollars, maybe that top currency share drops to, I don't know, 40 or 50%.
And the rest?
Spread out more among other major currencies, euros, yuan, maybe others, you get a more diversified global reserve base overall.
Okay, so in this evolving picture debt, value transfer, multipolarity, neutral assets rising, where does Bitcoin fit right now, according to this analysis? Is it a central bank reserve asset today?
This is a key distinction the source makes. While it could be one day, it's probably not going to be widely adopted by central banks as a primary reserve asset right now.
Why not?
Because central banks hold reserves for emergencies, essentially. They need big, liquid, reliable, relatively stable assets they can sell fast if they need to defend their currency or backstop debts.
And Bitcoin isn't that yet.
Well, it's around a $2 trillion market cap, only 16 years old, still quite volatile. It doesn't really fit that need for massive, stable liquidity you can dump in a crisis without crashing the price. Think gold or U.S. treasuries. That's the traditional reserve asset profile.
Okay, so if not central banks yet, where is it showing up, according to the analysis?
It is starting to appear in sovereign wealth funds, especially those from creditor nations.
Ah, sovereign wealth funds. Different purpose, right?
Totally different. They're about long-term wealth building 10, 20, 50 years out. For that kind of time frame, Bitcoin's volatility is less of an issue, and its potential as that neutral digital store of value in a changing world looks more appealing. It's an allocation for growth, not an emergency fund.
Got it. So central bank adoption is maybe something for way down the road?
Yeah, the source suggests it would need to get much bigger, like add a zero to its market cap, become way more widely held and therefore less volatile. Basically, start looking more like gold or treasuries in terms of market depth and stability. It's possible, but needs a lot more maturity.
Yeah, that really helps place Bitcoin in the macro context. Let's zoom back in on the Bitcoin market itself. Given the price action, especially the volatility, does the analysis see it as being in a bubble now? Are we near a major top?
The overall take is, no, not really. The market isn't showing those classic signs of a multi-year peak or, extreme speculative froth right now. It's described more as being in mid-market type territory.
What indicators suggest that?
Well, the analysis looks at a few things, like how old are the coins being moved? How is Bitcoin doing relative to wider macro trends? Also, the value of public Bitcoin companies compared to the assets they hold, the M/NAV ratio. None of these seem to be flashing red for a major multi-year top, according to the source.
And there was one specific on-chain metric mentioned, market cap to on-chain cost basis. Can you unpack that a bit?
Sure. It basically compares the total current market value of all Bitcoin to the aggregate price that was actually paid for those coins based on when they last moved on the blockchain. The source uses a pretty good analogy. Think of houses on a street. If one house sells for double the price, the other owners might think their houses are worth double now.
Right, they might list them higher.
Exactly. But the actual cost basis for the whole street hasn't doubled just because of one sale. For the whole street's value to really be validated at that higher price, you need more transactions happening there, more liquidity, time for the market to absorb it.
So it's about price discovery versus actual value transfer.
Kind of, yeah. Rapid price jumps can sometimes get ahead of the underlying cost basis being established. This metric tries to track that relationship.
And how does that metric look now compared to previous big market tops?
That's the key point the source makes. Current levels are way lower than what was seen at historical multi-year peaks. Back then, the metric shot up to much higher extremes, suggesting price had gotten way ahead of the actual on-chain accumulation.
But there have been periods of froth recently, right? The analysis mentioned moderate froth.
Oh yeah, definitely. It's not saying there's been no froth. It points to periods like March 2024 after the U.S. spot ETFs launch. Price ran up fast to around 73K, and that metric hit moderate froth levels.
Okay.
And similarly, after the U.S. election catalyst in October 2024, remember that followed a long, 7-month consolidation, price jumped again to maybe 107K, 108K, and hit similar moderate froth readings.
And what happened after those moments of moderate froth?
Consolidation. Multi-month periods where the price basically went sideways or pulled back a bit, like that 7-month chop earlier in 2024. And the source sees that as healthy.
Healthy. How so?
Because it lets the market digest the gains, the on-chain cost basis catches up, new buyers build positions, it works off the excess speculation without a massive crash. So the picture is more like mid-cycle moves hitting temporary exuberance, not the blow-off top kind of mania.
Okay, let's try and pull these threads together then. We've got this backdrop of relentless U.S. debt growth, structural, increasingly public. We've got the dollar's global role slowly shifting in a move towards multipolarity, which might favor neutral assets like gold, maybe eventually Bitcoin.
Right. And within that, Bitcoin currently looks more like a long-term sovereign wealth play than an immediate central bank reserve.
And crucially, looking at the Bitcoin market itself, key metrics suggest we're not seeing the signs of a major multi-year bubble top right now, despite hitting periods of moderate froth that were followed by healthy consolidation.
Yeah, it paints this picture of gradual but fundamental shifts underway. And that long grind economy, driven by the debt dynamics, means that value transfer is constantly subtly happening.
Which really brings it back to you, the listener. Thinking about this whole landscape, the debt, the shifting global system, the role of different assets, what does this analysis suggest for your own financial situation, your own positioning? How might understanding these really long-term currents help you navigate what's coming?
Definitely something to chew on as these trends keep playing out.